This is TreppWire Week in Review for week ending October 14th, 2022. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBX, commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Henry, Head of CRE and Advisory Services. This week, a gloomy 2023 economic outlook from the International Monetary Fund, and the UK markets are in turmoil. And in the US, all eyes were on the consumer inflation number, which came in hotter than expected. And all this was on the heels of a bigger than expected gain in producer prices and a strong unemployment number for last month. Manus, the stock market reacted immediately to the CPI number and then came roaring back in an intraday reversal. What was that about?
Our listeners are going to be shocked by this, but sometimes I'm left speechless, right? After 160 podcasts, they think I have an answer for everything. But today, watching the tape between about 8 o'clock in the morning, New York time, and let's say lunchtime, I was left with my jaw hanging. It was just an incredible, unintuitive outcome today. So, rolling back what we saw, futures were sharply higher before the print at 8:30 New York time. People were optimistic we were going to see a CPI number that was benign. 8:30 comes around, we see a hotter than expected number. The markets basically collapse. The 10-year treasury got to as high as 4.10% at one point, its highest level in several years, and well above the 4% previous peak that we saw a couple of weeks ago. The Dow was down 550 points or so. The broader indexes were down 3%. The NASDAQ was down 3%. And then all of a sudden, at, an hour in, an hour and a half in, the thing started to reverse course. And what we saw was one of the biggest trough to peak reversals that we've ever seen. The Dow went from minus 550 to up almost 850, a 1,400 point rally over the final 6 or 7 hours of trading. The 10-year treasury went from 410 to as low as 384 before closing at about 396, 397. Epic swings. If you were trying to hedge today or trying to time the market, you had to have your hands full today. On the other side of the curve, on the 2-year end, we started at about 425. That's where we opened the day. That shot up to almost 450. Just an epic move. Unlike the 10-year, which shot up and then retreated, the 2-year shot up and never turned back. It got as high as, I believe, 455 today. So really left speechless today by the moves, especially when you consider that there was really no satisfying answer for the rally that came, the bounce that we saw after that immediate sell-off, right? We were hearing on television, in our conversations with traders that we speak to regularly, in the print press, that people were buying the dip, right? That is a wholly unsatisfying answer and just hard to justify the strength of the move.
It's kind of like when you're a kid and your parents tell you to do something and you say why, and they say, just because I said so, or just because. And at this point, you look at all of the analyst reports before the CPI number came out, and they have all these different scenarios of what they think is going to happen. And then what you just outlined, what actually happened, like none of us would have ever predicted that. It leaves me feeling sometimes like, the people that are studying the markets all day, every day, at the end of the day, do they really know? Consumer behavior is just crazy. Trader behavior is crazy. The market fluctuates. Sometimes it defies logic. It's really interesting. I think we're in a unique position and we get to talk about it after the fact, but can you imagine the range of emotions and everything that's going on today for the different participants? And that's in light of all this other global stuff that's going on right now. So I think Martha mentioned in the lead-in, like International Monetary Fund revised some of their 2023 outlook and numbers today. So they came out and said they see the world economy growing about 2.7% next year, which is almost a full 1% lower than what they predicted earlier this year. They also revised their forecast for inflation upward for this year and next. They see price pressures, so deeply entrenched that central banks, especially the Fed, are limited in their options, but only, limited with their options except to move more aggressively and try to suppress demand. And then this comes on the heels of the UK markets, which we've talked about the last couple of weeks, their ongoing liquidity crisis. So Bank of England is still set to stop buying their bond to stabilize after Friday. Andrew Bailey, the governor of the Bank of England, warned in a speech earlier this week that, that they had 3 days, the pension funds had basically had 3 days to get their stuff in order. So a lot of moving parts outside of the US markets. It's interesting to see how the consumer inflation numbers, and we'll talk a little bit about this, but if you actually start to dissect it, and I think now everyone's an expert in dissecting CPI. If we had talked about CPI in detail 12 months ago, nobody would have known what the composition of that was or how it was calculated, at least to the level that they do now. But now there's a different narrative for each of the different subsets of data that drives CPI. So you parse out, depending on who you are and what you're looking for, non-energy, grocery prices, et cetera, and it seems like shelter is the main contributor. So basically accounts for about 40% of the increase to the core inflation number. And that number is derived from lagging indicator on the rent side. So we're going to have a little bit of discussion later today in the pod to kind of go through that. But I guess for me, my perception is just that the markets don't necessarily view CPI as an end all be all. They don't even necessarily view it as a direct indicator at this point of what's taking place. It gets a bunch of hype leading up to it. It definitely has some shock value initially, but then as people start to dissect it, you can change the narrative as needed based on your own, individual purposes. So, I'd like to get your thoughts, after seeing some of the rhetoric today. I know there were a lot of people that were on CNBC and a bunch of the other networks that were talking about different things. They have academics on to talk about it from an academic perspective. They have market participants. They have Jamie Dimon on. They have all these different people giving their perspective, none of which would have predicted what happened today prior to today's events. So just, as we go through this, has your perception of CPI changed? Has your perception of the market's reaction to such numbers changed?
Well, I would throw it over to Martha. She, before we came on this recording, she had a lot of data points that she was referring to. And I thought she built a good thesis. Martha, you want to run through what you were hearing today?
Yeah, I think the discussion today on multiple media was that the CPI number is lagging significantly, and especially when you're looking at the shelter number, which is showing an increase of 0.8% rise in rents. Those numbers don't necessarily reflect what's currently happening. And so you had Jeremy Siegel from Wharton, you had Diana Olick from CNBC, a number of other people pointing to data points. One of the most recent one was Redfin reported today that asking rents are growing half as fast as they were 6 months ago. In fact, we're looking at numbers that take some time to catch up in the CPI print, and we're not going to see that possibly for several months is some of the discussion. Well, the part that troubled me, though, is that when you look at the unemployment number that came out last week, as well as the job claims number that came out this week, and the commentary in both the producer index and the CPI number, the services inflation is still a problem. And services obviously is driven by labor. And so that becomes a really difficult problem that still persists. And I'm not sure necessarily how that problem is solved.
Yeah, I agree with you 100% on both of your remarks. I'll start with the housing side of it, which is interesting in that for the first 6 months of the year, people were saying that inflation was being suppressed because the housing inflation was not being reflected because of the way that they calculate the number, right? That we were seeing valuations going up by 20% per year on the residential side, maybe even more on the multifamily side, at least on valuation. We were seeing rents being driven up 10% or more for housing on the multifamily side, and that wasn't being reflected. And now what we're seeing is we're starting to see a little bit of correction on both the residential and the multifamily side. But we don't know if in that first 6 months, was it ultimately understated so much so that the lagging indicator that you're seeing now is like bringing you back into equilibrium, or are you still understated, or are you overstated, right? Because this thing has been so wonky for so long, right? Maybe the true inflation rate was 2% higher than what we were seeing. But because of this delayed factor in June, we weren't reflecting it. Now that we're on the other side of the mountain, and, at least on the headline, we're talking about an 8 handle, that what we're really not coming down from is an 8 handle. We're coming down from a 10 handle. And you don't really know. And I think that the people you were referring to on television today are kind of spot on, that there's a lot of noise there, that it makes it very hard to know how fast the number is either leveling off or decelerating. You just really don't have a lot of confidence in it right now. The labor problem, I was going to spin to something I spoke to today with, one of our researchers, PhD Stephen Bushbaum, who does a lot of real deep analysis for us. And one of the underreported elements of this economy right now is that you're kind of bifurcated, that among people who have left the workforce, they left because they were flush, right? They were ready to retire. They retired early. They had enough cash to sustain a certain lifestyle. They're not impacted by either the rise in wages or the drop in wages. They're impacted to some degree by gas prices and energy, but they're one segment of the market. But there's this whole other segment of the market that is benefiting from either not going to work at all, working from home and not enduring commuter costs, or they're taking advantage of this $15 to $20 an hour minimum wage and working 2 jobs. So while you would think that the inflation would take a bite out of these people, the fact that they're so flush in other areas is muting the fact that gas and food is eating away at their purchase power, right? So we're just kind of in unprecedented territory with the workforce, the participation, rising wages, expenses to get to work, and how many people are working 2 jobs. It's very noisy out there, and I don't envy the Fed right now or any of the central banks that are trying to make head or tail of this, given all the noise out there. Generally don't envy the central bankers, period. I think that, even when data is very clean and crisp, I'm glad I'm not a central banker.
Yeah, so just to piggyback on some of the other earlier comments, we didn't really dig into it, but mortgage rates, we talked about last week, they were at 6.66%. This week, they inched up to 6.9%. This is for residential. And then the volume of applications for purchasing homes, produced by Mortgage Banker Association, was down 39% as compared to the same week last year. And I think if you looked at the refinancing, it's down something like 80+%. So, that industry is really struggling at this point. And I think it's indicative of just what's taking place. I did see some content on Twitter today. It pointed out a suburb of Austin, Texas, Leander market. So the Leander market. About 6 or 8 weeks ago, we were on the pod and I was referencing, I think it had 35 active listings in the MLS total. And now it's one of the highest cities in the nation in terms of active listings. So that market has gone from hyper undersupply in terms of available homes for sale to now one of the largest available markets for homes for sale in a very short period of time. And so it'll be very interesting just to see how all of that plays out as well.
Well, obviously, higher interest rates have impact on real estate, as you mentioned. And we saw a story this week in the Wall Street Journal about real estate firms that are dealing with high interest rate hedging costs.
Yeah, I'm going to get into a little bit of an educational segment here and maybe some inside baseball. This came up a lot over the last 2 weeks, and it mostly impacts the CRE, CLO market, but it also impacts the large loan floating rate market. And what we're seeing right now is a lot of these borrowers locked in for the first year or two of a floating rate loan terms that were locked in when, let's say, SOFR, the successor to LIBOR, was well under 1%, maybe 25 basis points or 50 basis points. So their borrowing costs were extraordinarily low. Now, when you lock into something for 2 years, you normally have to buy an interest rate cap. And I want to mention a couple of shout outs. I had a couple of guys that were educating me on this over the last 2 weeks. I don't want to give them by name, but they were just very helpful for explaining this to me. So when you're buying this cap at time 0, you're buying a cap that prevents your interest rate from getting to a level that would drive your debt service coverage ratio below 1.20x. So you buy this cap to protect yourself from having a negative debt service coverage ratio. But most of these floating rate loans, and a lot of these are in the multifamily repositioning subcategory, that at the end of 2 years, you're only halfway through your business plan, and the loan is structured with 2 or 3 12-month extension options to let you finish your business plan. It gives you some flexibility. But at the end of that first 2 years, you have to rebuy another cap. And that cap has gone from being not very expensive a year ago to being phenomenally expensive right now. And so picture a case right now where you had a loan that had a 3% coupon on it because SOFR was, 25 basis points, right? And you had a 2.75% spread. And that gave you a DSCR, let's say for argument's sake, of 175, right? Your revenue was well above your debt service cost. But now you have a SOFR that's a 3 handle, and your rate should be resetting up to almost 6%, basically eroding your NOI and eroding your debt service coverage ratio. You have to buy a cap that limits your interest rate to a level that will not allow your debt service coverage ratio to go below 1.2. That's extraordinarily expensive right now. It's expensive because people don't know where rates are going. And it's also expensive because of what the move we've seen thus far. People have said, if we move 300 basis points so far, what's to say we're not going to move another 300 basis points? So these guys are getting hammered with a cost that they didn't see coming. And you may see a situation down the road where these borrowers really have to come out of pocket to make this payment. In fact, one of my sources today said people have had to buy a cap to make their debt service coverage ratio work that is below what they're paying now in interest costs, meaning their rate now is 5%. They're not buying something that caps their rate. They're buying something that suppresses their rate to make the debt service coverage ratio work. Now, to be fair to our listeners, I got into some real detail there. This is detail I didn't really understand the nuance of until 2 weeks ago. So if you're not understanding the nuance and you want to get on the phone or talk about this, feel free to reach out to me or Lonnie or Martha, and we can set up a Zoom, because this is really inside baseball, but it is impacting borrowers in a big way.
Yeah, I think the headline is the interest rates, and that's what everyone focuses on. But this is, proof positive that there's additional ancillary cost to operating a property on the debt side. So, especially for younger, newer GPs that have maybe syndicated deals and didn't have an understanding of this at this level, and now they're, like you're saying, maybe a year into their repositioning plan, and it comes due that they're going to have to spend. And I think in the article that was in the Wall Street Journal today, they actually referenced in some instances it was a 10-fold increase in the cost of those caps. So if you're not accrued for that, or you don't have reserves set aside for that, it's a very precarious position to go back to your capital providers or investors and say, hey, we're going to have to pony up to buy this this hedge or this interest rate cap, and then explain that to them so they're comfortable, and then still be able to execute and operate your stabilization plan. So there's a lot of moving parts, and I think these are all those things in the market that when things were humming along and operations were great and capital was plentiful and the cost of capital was near zero on a relative basis, you just kind of breeze through some of the fine print, or you complain about paying $10,000 or $12,000 for a rate cap. And then now I have a couple of examples in the article where, for $100 million interest rate cap tied to SOFR, average price in October was $2.2 million, which was $200,000 a year ago and $45,000 2 years ago. So as Manis explained, this is not some nominal increase in cost. This is something that could really be problematic for somebody operating a property with this type of a floating rate structure.
Right. The closest thing we've seen to this in an adjacent market would be during the great financial crisis. All the people that bought second homes or even first homes on spec with subprime loans, subprime mortgages, subprime FICO scores that were given teaser rates. for the first year or two, right? Deeply discounted first 24-month interest rates. A lot of them, if you've watched The Big Short, did not know that their loan was going to reset from, let's say, a 3% annual rate to maybe a 6% annual rate. And when that happened, they were hit by a 2x4. They were watching their debt payment double, and that accelerated the defaults that we saw in the Florida market and elsewhere, where there had been incredible speculation, right? Here we're dealing with much more sophisticated buyers, the people that are buying and repositioning these multifamily, but the pain is similar, right? It's something that came out of left field that hit you in the back of the head. And to Lonnie's point, another group of people I don't envy is the people who have to explain this to their partners, right? This is not, something that, is trying to explain batting averages in baseball. This is really kind of deep finance, and getting people to understand this is not going to be easy for the passive investor. Where this is going to hit the road elsewhere is that because these caps are expensive, people that would normally tap the CRE CLO market to buy a property and reposition it, the economics don't work anymore. So what we at Trepp have seen is a real grinding to a halt of the CRE CLO market, which means people are not raising funds to buy new properties, which means they're not buying new properties, which means that demand for properties is becoming smaller and smaller. And that will, for those who own portfolios, should be reflected in falling valuations in the coming months. So it's double sorted. It's not just for the guy who's halfway through the repositioning. It's for that would-be buyer who an owner of a property is looking to use as an exit vehicle. He's constrained too.
Yeah, and the CRE CLO market had seen some fairly large expansion over the last couple of years, man. It's given that we were on the other end of the interest rate spectrum. So in 2021, that was about 45 billion in total issuance at year end. And through the first 9 months of 22, CRE CLOs accounted for about 27 billion worth of issuance. We had a really nice article in the CRE Direct publication this last week that actually gave a really detailed chart of all of the domestic private label CMBS issuance on a year-over-year comparison, 9 months of 21 compared to 9 months of 22. And so it'll be very interesting to see how that trend, up until September, the CRE CLOs were actually tracking right along with the 21 issuance. But to your point, it's really come to a complete stop. So we'll see how those play out. And I think for all the ones that are sitting out there with those 1, 2, or 3 year, 12-month extension options, in addition to paying those interest rate caps, if they meet debt service covenants and are eligible to extend, there's usually a 25 or 50 basis point extension fee that goes along with renewing that loan. So the back end of some of those deals are proving to be costly.
And while we spend a lot of time talking about inflation in rents and shelter, we're going to stick to multifamily. And we had a segment we introduced last week, Digging for Data. And I got to hand it to Haley, who dug up a very nicely sounding bulldozer sound. So that was good. We'll have to cue it again. We're going to dig for more data.
Yeah, so we've kind of gone through this introduction of digging through the data here on the podcast, and I think the last couple of weeks we've spent some time talking about the credit side or the debt side of the equation, where we looked at debt service coverage ratios, we looked at upcoming maturities, et cetera. What I wanted to do today was look a little bit more on the operational side, and so what I've done is put together a list of MSAs where the most recent weighted average revenue for multifamily properties, and then given, say, the top 5 markets. So in this example, we're looking at all multifamily properties. We've isolated the subset of data to the top 50 MSAs, because some of these could get really wonky if you include all of the MSAs, because if they have 1 or 2 high-end properties, it really skews the number. So we're looking at just the top 50 MSAs, and we're looking at most recent weighted average revenue on a per unit basis. And so, it's actually good news in this case for San Francisco. We've had a lot of negative news for San Francisco on the office front. But if you look at their multifamily, so this is San Francisco, Oakland, Hayward, California MSA. If you look at what their weighted average revenue per unit is for 2022, they lead the pack. They're about $56,000 per unit on the revenue side. They're about 34,000 per unit on the NOI side, and that MSA has a trailing 12-month occupancy at about 92%. So really strong multifamily market still, even with some of the downsizing in the office sector and the right sizing of some of those tenants. The next four in order in terms of, highest to lowest on that per unit revenue number would be the San Jose market, Santa Clara, New York, Jersey City. Interesting here, Providence, Warwick, Rhode Island, they're at number 4, and then Miami, Fort Lauderdale, West Palm comes in at number 5, followed by LA and Seattle. So some of the markets you probably would have expected on the revenue side, and maybe one or two that you wouldn't have. And then we can parse the data and actually look at it in a bunch of different ways. If we wanted to look at weighted average NOI per unit, the results shift slightly. You have San Francisco still at 1, San Jose, Sunnyvale, Santa Clara at 2, New York, Jersey City at 3. LA moves up to number 4 on the NOI side, even though they were 6 on the revenue. And then Seattle, Tacoma is number 5 on the NOI side. So maybe some more favorable in the California instance, property tax treatment, or maybe some of those other expenses are a little more favorable for the operator. So they have a little higher NOI margin, a little higher NOI per unit on that. And then lastly, I wanted to highlight some of the origination data across the multifamily subset, and then give a quick comparison to the office sector, because I know we've talked a lot about the office market not really showing some of the signs of distress in the form of special servicing or delinquency, but our supposition that maybe there's, some shadow challenges in that space. So if we looked at the top 50 MSAs for multifamily, and we looked at last quarter origination, the summation of that issuance was about 14.6 billion across all 50 MSAs for multifamily, led by the DC MSA, which I thought was really interesting. So I'll let Manis opine on this in a second, but Washington, Arlington, Alexandria led the last quarter issuance in multifamily at about 1.2 billion. Atlanta was number 2 at about 828 million. Then you have New York, Chicago, Denver that all trailed at, 650 million plus and up. If we pivot though to the office market, it's a stark difference in terms of issuance and in terms of MSA issuance. So if you look at the summation of the top 50 MSAs for office, total issuance last quarter was about 560 million as compared to that 14 billion number on the multi side. And then if you look at the individual markets, none of the MSAs eclipsed 200 million in issuance on the office side. So, some really interesting perspective there. We know multifamily in terms of number of properties and opportunities for issuance, clearly there's just significantly more. So we're not naive to the fact that there's some multiple of multifamily properties relative to office. But if you look at the top 50 MSAs and have less than $1 billion of issuance for office, I think that's pretty daunting, compared to historical norms.
Well, I think you have a couple of things going on. I think, kind of the glass half empty side of it is offices are the new malls. Mall financing was plentiful in 2012 and 2013. By the time you got to 2016 and 2017, by the time that things like Toys R Us and Sports Authority and Bon-Ton and Sears were on the ropes, financing was really, really hard to come by in the CMBS market. It was, in some cases, shut down and unavailable. And while I think strong offices can still get financing, we're not in the mall space right now, it does kind of rhyme with the mall space in terms of 2017, right? You have to have a decent tenant base. They have to be locked in for a long period of time. It has to be a desirable building, not a B or C. You have to have a lot going for you to lock in financing in the CMBS market in the office space right now.
So let's start with some of the property sector news, and we'll start with office. We had a couple of positive signs. First one coming out of New York City. Yeah,
this was the Real Deal came out and said that 9 West 57th Street, which is a real high-end New York City office, not far from Carnegie Hall, not far from Central Park, is being put up for sale by the Salau family, filled in Salau, or is it Salo? People know that I'm terrible with names. His heirs are getting ready to sell that The property was valued at 3.4 billion a couple of years ago. Backs both a single asset CMBS deal and some slugs of the debt are spread across conduit bonds as well. This is interesting, right? You wouldn't think that this is the time to put this out for sale, but they're going to dip their toe in and see if they can move this thing. And the fact that they're going to try this is a vote of confidence for the high-end market. And if they pull it off, I think it'll be a very, very encouraging sign for a market that needs encouraging signs, honestly. So let's hope that they get this over the finish line and at a level that is above what we saw in 2016.
Yeah, so 1.7 million square foot property, Manus, $3.4 billion value in 16. Top tenants are Apollo and Chanel. And it looks like really strong debt service through the first half of 22, even with occupancy lagging at about 72%. So, hopefully this can maybe set a new watermark on the sale side in the office market.
Yeah, this is one of those places that, it's so boutique in its demand. It's one of the few places in New York that you're getting where you historically have gotten well above $100 a square foot. Some of those upper floors there have been said to go for like $300 a square foot. Just a really, really desirable spot and pretty accessible. If you're coming in from New Jersey or from Westchester County and you're a car service guy or you're a driver, it's not far from the West Side Highway. You're not kind of going into Midtown, into the heart of Midtown. So it is a nice location. And like I said, let's keep our fingers crossed that this happens.
And our next story takes us to Atlanta, where a tenant behind an office loan puts their space up for sublet.
Yeah, this is an office property, 2300 Windy Ridge Parkway. It's about a 700,000 square foot property, mid 1980s vintage. Prima, under the name DS Services of America, is the second largest tenant, has about 9% of the space, and they have a lease that runs through the end of 2025 or close to the end of 2025. It backs about 65 million Wildwood Center loan, which makes up about 8% of collateral behind a 2013 JP deal. As part of CMBX 7, had a 1.17 debt service coverage ratio through the first half of 22, and occupancy was hovering around 79%. This is one of those properties that does have an upcoming maturity in late 2023 with that 1.17 DSCR. And top tenant currently is Manhattan Associates, which occupies about 32% of the space. Negative there is that it also has a lease expiration at the end of 2025. So this is one that, has a couple of the two largest tenants with lease rollovers potential in 25 and upcoming maturity in 23 and subpar debt service coverage at 117. So be interesting to see what happens with this deal, especially since they're putting up that space for sublease currently.
Yeah, a couple of the crabgrasses that we have in California. WeWork had leased almost 500,000 square feet to Facebook. Facebook has pulled the plug on that. We've talked about Facebook several times before about them giving up space in Park Avenue South in Manhattan, about pulling back in the post office area by Penn Station in New York, and now giving up 460,000 square feet in California. This is an interesting story. The space was originally leased to LinkedIn. LinkedIn was bought by Microsoft. Microsoft did not want to keep the space, so they assigned it to WeWork, but they're still on the hook to guarantee the lease in the event that WeWork has credit issues. WeWork made the space available for Facebook, and now Facebook is pulling out. But Microsoft is on the hook until 2029 to guarantee this lease. So no credit issue. It's more a story there of another big tech firm, pulling back on an enormous amount of space once again. Elsewhere in the post office area of Chicago, we saw TrueBlue, which is, I think, a marketing firm. They've made about 90,000 square feet available for sublet. And in Georgia, there are reports out that we have yet to confirm, that we are trying to confirm, that Home Depot is on the verge of giving back 600,000 square feet of space, office space, not retail space in that market. We're going to try to confirm that and hopefully have more color on that next week. And in Hasbro, giving back 100,000 square feet in Burbank, California. So a lot of crabgrass there, not a lot of green shoots.
And then let's wind up with a retail story out of Florida.
Well, I was talking about Hasbro. I was thinking it was a great opportunity for us to talk about Shoots and Lonnie. Right. Last week we talked about Lonnie on a ledge. We could talk about Shoots and Lonnie
cute.
as a board game. Right.
It's
That,
just going to be an
you get to that
entire
shoot.
line of children's
Right. All of
merchandise.
those characters that go up the thing, they could all have Lonnie's face on them. And if you get to the shoot, you go shooting back down to the beginning. So we have a couple of mall stories this week. You can look for them in TreppWire on Friday morning. If you're not a TreppWire subscriber, we'll make these 2 freebies that we give you. We haven't done a freebie in a while. One of them talks about a big CMBX 6 loan that has had a loss that was reported today in the remittance data that will come out tomorrow morning. And the second is about a big loan that has been on the ropes for a long period of time, that has been refinanced into a 2022 deal and should result in a full recovery for a loan that was problematic in the past. And lastly, one that came out earlier this week, there's a comm deal from 2012 that's backed by 2 large mall loans. One is the Oaks Mall in Gainesville, Florida. The other is the West Roads Mall that's in Omaha, Nebraska. Both loans were slated to mature this week and both missed their balloon payment dates. So they move from in play to purgatory. We'll see what happens with those, but something to watch in the coming months.
And I have one note to make that might be of interest to our listeners. Our sister company, CRE Direct, publishes a quarterly data review. That's supposed to drop the last week of October. It is a free publication that is chock full of analysis and data provided by both Trepp analysts and CRE Direct reporters. If you're interested in advertising in that piece, give us a shout. We will plug you into the team that works with them, and it could be a great way to get some exposure with folks in the commercial real estate and finance space. And shout outs. We had a number of people ask for info on the Altus webinar panel. Perul, Cameron, Matt, aka Oz. How did the panel go, Lonnie?
Yeah, the panel was incredibly well attended. They had a very large number of attendees that pre-registered, and we had a really great turnout. And I've already had a couple of people reach out post webinar panel. Amarit G and John B saying it was a really informative panel and they enjoyed it. So thanks to Altus for including myself and the team in that discussion. And if there's anything from the webinar, if you were an attendee that we talked about, the special servicer report, the delinquency report, or anything else that we referenced during the panel, please feel free to reach out. We'll be happy to send you a copy of those things.
And Manus was out on the collegiate circuit this week.
Yes, I'd never done this before, but Professor PhD Lily Shen at Clemson asked me to come in and do a couple of guest lectures. But I got to say, it was a lot of fun. Great to meet some young tigers. Hopefully some of them will go into the commercial real estate space. I really enjoyed it, and I look forward to going back again. It was really terrific. So thank you, Clemson and Professor Shen, for hosting me, and for the audience for being so patient and respectful. I got to say, that listening to me for 2.5 hours, I know you guys do it often and with great regret, I'm sure. These tigers, they didn't know what was coming. And I got to say, they dealt with it, the adversity of it all, very well.
Shaping young minds.
Yes.
And Dan M., who we haven't heard from in a while, shared our mention in the Wall Street Journal. Chris S. recommended our pod. And Shlomo C. quoted some of last week's takeaways on Twitter. Sean T. was interested in our Market Pulse, which is one of our recent Week in Review publications. If you're interested in that, it's free. We would be happy to send it to you. And Susie S. loved Lonnie on a Ledge. I think it's on their holiday shopping list. I'm not sure. Siri Property Report on Twitter said, "Oh, you mean Tickle Me Lonnie." So if you haven't seen Haley's photoshopping skills, you should check it out. She's got her own version of Lonnie on a Ledge.
I got to say, I'm perplexed as it pertains to Lonnie on a Ledge. And oh, you mean Tickle Me Lonnie? I'm a little sad that they didn't go more viral, but I'm actually kind of happy they didn't go more viral. So that's the conundrum. Like, Great job by Haley. Made me look super nerdy, but kind of cute. Didn't go viral though. So, I mean, like, I don't know. Maybe we'll have to, try something new. Yeah.
Well, yeah, Haley can make anybody look lovable. I got to say, that's one of her gifts. Just a couple of closing thoughts. We've gotten some really, really detailed technical questions from some of our listeners. We're not ignoring you out there. We try to squeeze in answers for these things as best we can, but there's 3 or 4 guys out there waiting for us to cover some really meaty topics. If you haven't heard us talk about them yet, they're still on our list, and we're going to get to them at some point. So thank you for your engagement and your really thought-provoking questions, and look for some segments in the coming weeks over them. You haven't been forgotten.
And with that, we'll close. Thanks to our producer, Haley Keene. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or comment, send it to podcast@trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening, and stay well.
All right.